Good morning and afternoon to everyone. Thank you for joining CFRA's webinar reviewing our 2019 biggest concerns performance and what you need to know for 2020. I'm Jennifer Latz, the Director of Forensic Research at CFRA. Joining me a bit later in today's webinar as presenters will be Zhen Dang, a Senior Analyst on our Bespoke team, and she's also responsible for thematic and technical research, and Richard Zabasnik, who heads our financials vertical. Before we get started, I want to remind everyone that we're recording today's session and a link will be provided to everyone in a few business days. We have four items on today's agenda. I'm going to be covering the first 2 points, and Jen and Richard will be covering the third, and then as we get questions in, we will share the Q&A section. We want to remind you that you can submit questions today using the GoToWebinar panel, and we will do our best to get to all of them. So just a reminder of what CFRA does every day. We are, on the forensic research side, we are focused on differentiated and actionable research to help you make better investment decisions, and I think that we are quite transparent in terms of our proven track record, as evidenced by today's webinar, where we will cover not only our greatest hits from 2019, but some lessons learned as well. We work with clients in many different ways. Our forensic accounting product focuses on finding those nuggets and disconnects between what the financial statements are saying and what the market believes. And through the forensic accounting product, we cover about 250 companies each year. Our Legal Edge product focuses on companies' legal risks and the asymmetry between how the market understands and is pricing the legal risks. Our Bespoke research is custom work on the companies that you choose that are most important to you, and I'm excited to highlight for 2020 that due to client demand and feedback, we've added a new Bespoke product, our Bespoke Edge library. This gives the clients the ability to have access to a library of topical and trending names. And some of the other benefits of our Bespoke Edge library include names that are more widely held, and also situations where CFRA may have fewer concerns on names where the market or competing research firms may have developed and marketed their concerns via short selling reports. And then lastly, we also are spending time on industry and educational reports, and here we're trying to show through our sectors the standouts and the laggards based on more hard to track or undercovered metrics. So for example, we look at things like cash flow quality, reverse factoring, receivables factoring, or executive and board departures within the industrial sector. And I'd like to highlight on the industry reports a terrific resource we have, which is called our Industry Risk Assessment Profiles, or IRAPs for short, and these are updated every other year, and we recently updated them in January of 2020. And these are currently available on our website by subsector, and they highlight the accounting issues and line items that analysts should be most concerned about for their subsector. And each of the 69 IRAPs include a risk assessment checklist and specific examples from companies that CFRA has covered in the past or where we found really interesting disclosure. So now we'll move on to the second item in our agenda, which is the 2019 review of our biggest concerns list. And I think the best summary here is mixed results in a surging market, and let's get into the specifics by region on the next slide. Just as a reminder, FRS, we are looking for underperformance of benchmarks. And despite the trade war news dominating the headlines in the year, unrest in France and Hong Kong, and then the impeachment of the U.S. president overshadowing news in the back portion of the year, the market surged globally, as you can see here. And the MSCI benchmarks were up double digits in each geography. and it felt somewhat similar to trends going on in 2009. As far as overall themes at CFRA for underperformance, I think healthcare, industrials, and retail consumer names fared best this year in terms of underperformance, while IT space, particularly semiconductors, was a difficult area for picking underperformance. And jumping into North American performance, this is the first time in 10 years and only the second time since we've started tracking performance in 2005 where CFRA has had negative alpha in North America. And the biggest concerns list was up 39.5% in 2019, while the MSCI benchmark was up 29% for negative alpha of 10.2%. I think in summary, we had a tough June, but that was followed by a very strong July and August half-year results season with Textron, Balcom, Superstein brands, and then in Europe, Siemens Gamesa providing really successful in Q2 earnings in terms of disappointment. But only one of those, which is Textron, is one that ended up being one of our best calls for the entire year. I would also highlight that in terms of 2009, that was followed by 6 years of very strong double-digit excess performance. And in Europe, that trend was even more pronounced post-2009, with 4 years of 24% or greater excess return. And even though we only have about 6 weeks of data so far in 2020, which is not much time, we've already had 3 companies report one-day double-digit declines. So hopefully that continues as the year progresses. And then more specifically on key winners for North America in 2019, Allscripts is a healthcare technology company where the thesis was based on the changes in revenue recognition, which is known as ASC 606 in the U.S. And for MDRX, after adjusting for the adoption of this new policy, our healthcare analysts felt the true organic growth was below both 2019 and longer-term organic growth targets. Cantel is another top performer for the region, and it's in the healthcare equipment space. C&D had more of a working capital angle to its revenue story. The company implemented a new ERP system, and both inventory and receivables were elevated. And the company's results kind of unwound a bit and had to revise their top line growth for their largest segment downwards in October. Textron is another ASC 606 example. And this also had a quality of earnings bend. And given that Textron had taken advantage of some percentage of completion loopholes and had some several favorable changes in estimates margins, we were concerned about performance there. In terms of detractors, Triumph Group is a situation where over the life of its time on our biggest concerns list has generated 118% positive alpha, but in 2019 we overstayed our welcome a bit. And the crux of our concerns over the life of the nearly 5-year stay were highly aggressive acquisition accounting. But going into 2019, the concerns were more centered around potential trouble repaying debt. But TGI was able to transition one of its wing programs to Bombardier, and then later in 2019 was able to refinance a portion of its debt. Jabil concerns centered on revenue growth that we believed may not have been sustainable due to rising DSO, and a significant increase in their factored receivables also may have helped provide a non-recurring boost to their free cash flow. However, the company was able to exceed its original revenue guidance for 2019 with some additional new business awards, albeit at fairly low margins. And lastly, in terms of performance detractors in North America, CarMax is a situation where I think our lesson learned here is that there was some flawed interpretation of the data, including rising used car prices, coupled with a regime shift on interest rates and consumer delinquencies flattened, which we were not expecting. So moving on to Europe, our biggest concerns list in Europe was up about a little over 20%, while the MSCI benchmark rose about 23.7%. I think the key differentiator here between Europe and the other regions in 2019 that resulted in the positive excess performance is although this hit rate was quite similar to North America, the performance detractors here, which we'll talk about on the next slide, were not quite as impactful. So our best calls in Europe were across 3 different sectors this year. Hugo Boss was initiated in February of 2019. The thesis centered here on not only rising inventory, but the wobbly explanation from the company on both the cause and what they thought the impact would be on margins. They also had quality of earnings issue at Boss as they had begun reversing some provisions. So the stock drifted downwards in May after disappointing Q1 EBIT results. Inventory continued to climb throughout the year, and then ahead of Q3 results, the company warned on both the top line and EBIT margin guidance. Andritz is an Austrian company, and somewhat similar to Boss, had both working capital and earnings quality issues. And Andritz's increase in receivables coincided with margin pressure and customer demand weakness in certain segments. And we also believe that future margins could be pressured by the absence of non-recurring benefits to margin growth from some things like provision reversals and the sale of fixed assets. And then in Q1 19, this played out as Andritz lowered its guidance for the fiscal year profitability, sending the shares down about 12% on the day. Electa was added in August in 2019 on top line concerns, which were evidenced by extended payment terms, higher past due receivables, and higher unbilled receivables. The latter of which is a real red flag, given Electa's operations are largely project-based. In November, the shares fell upon preliminary Q2 20 results due to delays in some installations. In terms of detractors for 2019 in Europe, Spectris, it was a story based on weak like-for-like revenues and earnings headwinds from rising inventory and cost capitalization anniversarying. However, the company completed the sale of one of its businesses in December and was able to highlight some of the strengths in its restructuring program. And Landis & Gyr is an example of where I think, measuring, we have to pick a date to measure, and in this case, it's, January 1 to December 31st, but this did crack earlier in 2020 with disappointing guidance and a change to its dividend policy at the Capital Markets Day. And lastly, in Europe, Siemens Gamesa has lowered its EBIT guidance twice since its stay on the biggest concerns list. But the negative excess return from 2019 was really upon the bankruptcy of one of its competitors, as well as some rumors and the eventual announcement of Siemens buying out a minority shareholder. So in Asia, performance struggled this year, particularly in the back half. This was driven by disparate factors, including some wrong calls in the tech sector and the takeover bid, which we can discuss in detail on the next slide. But as a result, we registered negative performance in 2019 of 18%, with BC names up about 35% versus the benchmark up 17%. Among our winners this year, Auto Home was one of the best calls in Asia with a total return of negative 12.3%. And the thesis on Auto Home was driven by a belief that dealers were really struggling given the difficult end market. And we could see this in the accounting signals, which were rising DSO due to longer payment terms and deferred revenues, which mainly represent dealer subscription services, were slowing. And in the fourth quarter, revenue guidance disappointed along with downbeat 2020 commentary on dealer subscription pricing. RWC was our second highest excess return generated in the Asia region. And Louise, the covering analyst, she focused on a recent acquisition and the company's inclusion of a positive weather event in its 2019 guidance. And the stock unraveled with a weak May trading update and light 2020 guidance. And on the detractors within the Asia region, CBPO is a NASDAQ-listed Chinese biotech company, which was an unfortunate situation where a consortium offered to take the company private, sending the shares up. And Fanhua shares recovered on the first quarter 19 results after the company was able to change the accounting on shares repurchased for employees and management. And through that, they were able to reduce their share count and really help their per share metrics despite little true underlying improvement. And then on the day of our removal, the shares rose 12% on little news. And so just to remind everyone, our alpha is calculated somewhat conservatively in that we don't include performance on the day of addition, and we don't include performance on the date of removal either. This concludes the first two parts of the four-part agenda. I will turn it over to Zhen Dang now, who will cover what you need to know in 2020.
Thank you, Jennifer. We will discuss 5 accounting issues for investors to know in 2020. The first is the FASB's new credit impairment model, which is already effective for larger companies. Next, we will discuss how a couple of recently implemented accounting standards, namely leasing and revenue recognition, have impacted our analysis at CFRA. We will then touch on reverse factoring, as there is diversity in how these arrangements are accounted for. Finally, my colleague Richard will provide a summary of the upcoming changes to insurance accounting. Our discussion of all of these issues will be from the perspective of a global investor. That is, we will compare and contrast major provisions under US GAAP and IFRS. The new expected credit impairment loss model, credit loss model for US GAAP, known as CECL, became effective on January 1st, 2020. Companies that meet the SEC's definition of smaller reporting companies have a delayed effective date of 2023. The new model makes significant changes in a number of areas. We will highlight 3 of these. First, loss reserves must reflect credit losses expected over an asset's contractual life. Under the previous guidance, losses were recognized when the occurrence is deemed probable, and the loss period was typically 1 year. In estimating lifetime losses, companies must incorporate reasonable and supportable forecasts of the relevant economic factors, as well as taking into consideration past experience and current conditions. The second major change is the accounting for purchased financial assets with credit deterioration, known as PCD. Under the new model, the initial amount presented on the balance sheet is the purchase price plus an allowance for credit loss expected at the time of the purchase. Under the previous guidance, establishing an allowance on day 1 was explicitly prohibited. In subsequent periods, changes in the estimate, both positive and negative changes, will be recorded as part of loss provisions. Under the previous guidance, favorable changes were included in interest income, while unfavorable changes were recognized as loss provisions. The third change we want to highlight here is the treatment of impairment losses for securities classified as available for sale. Previously, A credit loss was recognized through a direct write-down of the asset value, and reversals were not permitted. Under the new guidance, credit losses are recognized through an allowance account, which means reversals are permitted if the outlook improves. The range of financial instruments that will be subject to CECL is broad. A few examples include loans, receivables related to revenue, that is, trade receivables and contract assets. Also included in the scope are investments in leases, held to maturity securities, and certain off-balance sheet items such as standby letters of credit and loan commitments. In terms of the impact, CECL generally will result in earlier recognition of losses compared with the previous model because CECL requires day one recognition of lifetime losses. At the adoption date, companies will record the cumulative effect in retained earnings. In other words, an adjustment to owner's equity at January 1, 2020 for calendar year companies that don't qualify for the delayed effective date. We expect the typical adjustment to be an increase to the loss reserve and a decrease in owner's equity. While this transition method is required, we wanted to point out that if the cumulative effect turns out to be overestimated, post-adoption companies may recognize below normal credit losses or above normal earnings. Additionally, the pattern of profit recognition may change for some companies due to upfront loss recognition under CECL. For example, Credit Acceptance Corp estimated a negative impact of 30 to 60% on its 2020 earnings. Most of the impact is expected to occur in Q1. So which companies have the most exposure to the accounting change? For financial companies, those that have significant consumer loans, credit cards, and purchase loans will likely have to increase their loss reserves the most. The impact on regulatory capital is expected to be more moderate, as companies have the option to phase in the day one impact over 3 years. Certain non-financial companies may also report a substantial adjustment. For example, Ford estimated an increase of close to 40% in loss allowance as of September. Compared with IFRS, CECL is different from the expected credit loss model under IFRS 9. Both models incorporate forward-looking information. As mentioned before, CECL requires day one recognition of lifetime expected losses. The model under IFRS 9, in contrast, distinguishes between stages of credit deterioration. Lifetime losses are recognized for assets that have had significant credit deterioration since initial recognition. Otherwise, 12 months expected losses are recognized. This is the most significant difference between the two models. IFRS 9 became effective in 2018. So we have some post-adoption data points. Certain phenomena we have observed among IFRS companies may occur in the US as well. Our first observation is banks with strong capital positions pre-adoption were able to substantially increase their loss reserves at transition. This potentially allowed them to report higher earnings through lower impairment losses in the immediate post-adoption years. Our second observation is some companies took a significant write-down of long-term investments at transition. The effect was recorded through owner's equity, which otherwise would have been charged to earnings. Moving on to lease accounting, implementation of the new guidance will anniversary starting in Q1 20. We'd like to point out that for US companies, besides the well-known balance sheet effects for lessees, the adoption had a favorable impact on key performance metrics for some companies, but the benefit may not recur. As an example, for TCMD, certain rental arrangements are now accounted for as sales step leases rather than operating leases. In other words, revenue and expenses are now recognized upfront rather than over time for this type of contracts. This change contributed 3 percentage points to the year-over-year growth in Q3 19. The new accounting treatment may pressure future growth in the absence of strong new contracts. As another example, OHI, property taxes the company pays directly and is reimbursed are now treated as a revenue item along with an offsetting increase in operating expenses. This growth method of reporting accounted for the entire year-over-year growth in Q1 19. Some companies recognized impairment charges related to ROU assets at initial adoption as an adjustment to retained earnings. All else equal, the impairment charge will lower operating expenses going forward and may boost operating margin growth in the initial year of adoption. Finally, it is worth noting that finance leases are more favorable for the typical calculation of EBITDA and free cash flow compared with operating leases. Finance leases also have an advantage over outright purchases of PP&E for the typical free cash flow calculation because payments for principal are presented in financing cash flows. Therefore, increased use of finance leases may boost EBITDA and free cash flow if unadjusted. For IFRS companies, the favorable adoption effect EBITDA and cash flow growth rates in year one is well understood. Possibly less well understood is the benefit to margin growth if a company took substantial impairment charges at transition related to the ROU assets. Our point here is the benefit to growth rates in these metrics are non-recurring. Revenue recognition. The new guidance became effective in 2018, so in 2019, investors generally were able to make comparable analysis on a year-over-year basis. We wanted to share with you some insights our analysts were able to glean from the new disclosure items required under the Global Revenue Standard. The first item is remaining performance obligation. This is the amount of transaction price allocated to goods or services not yet delivered. The allocation involves discretion. Monitoring the changes in this item can help assess whether a company that has material long-term contracts is recognizing more revenue upfront versus prior periods, or whether the company may be at risk of achieving near-term revenue target due to weakness in the pipeline. The second disclosure item we found useful is the amount of revenue recognized from deferred revenue included in the opening balance and additions to deferred revenue during the current period. Comparing the trends in these amounts, investors can get a better sense for whether a company is winning enough new contracts to achieve future growth. Under legacy GAAP, companies generally disclosed only the ending balance in deferred revenue. The third item is contract assets. Revenue recognized for which a company does not yet have unconditional right to receive payments must be presented as contract assets, separate from accounts receivable. This item typically represents unbilled receivables. A significant increase relative to sales may indicate aggressive revenue recognition. In addition, some companies disclose the amount of contract assets that were reclassified to accounts receivable during the period. If contract assets are rising, yet the reclassification of contract assets to accounts receivable is slowing, then it can be another signal that the company is being aggressive with its revenue recognition. The last item I want to mention is the more granular revenue disaggregation under the new guidance. The disclosure can provide an additional layer of transparency regarding the drivers of revenue growth and the timing of revenue recognition, such as the proportion of revenue recognized upfront versus over time. Reverse factoring. We are bringing up this issue not because of a recent change in accounting, but because there is currently no specific guidance under US GAAP or IFRS. So our concern here is diversity in the accounting treatment, and disclosure is typically limited. Reverse factoring has a number of different names, such as structured payables or supply chain financing. It is essentially a financing arrangement where typically a financial institution or some other intermediary settles the company's trade payables. The company then pays the financial institution at a later date. This arrangement effectively lengthens the payment terms for the company and improves working capital. Our issue here is there is lack of transparency and consistency in how these arrangements are presented on the balance sheet and the cash flow statement. The related cash flow can be in operating cash flow or financing cash flow. On the balance sheet, the payables can be in trade payables, other payables, or borrowings. As a result, cash flow and net debt metrics can be skewed. In October 2019, the Big Four accounting firms sent a joint letter to the FASB requesting guidance on reverse factoring. So stay tuned for any regulatory development on this issue. Now I'm going to hand the call over to Richard, who will discuss the upcoming changes to insurance accounting for US GAAP and IFRS. Richard?
Yeah, great, thanks. So both GAAP and IFRS are making significant changes to accounting for insurance. Both are expected to occur in 2022. But the insurance accounting this new insurance accounting got attention last year with a short report on GE, and we would expect both of these to get more attention as we get towards year end. Starting with US GAAP, effectively what it does is it eliminates distinct practices between traditional life insurance, between accounting for traditional life insurance and annuities. Both will be replaced with what's going to be best estimate liabilities for reserves that will be set, that will be updated at least annually. In addition, the discount rate, which right now for those liabilities, which has a lot of management discretion involved in it, will be reduced, and instead the discount rate will be set to an upper medium investment grade fixed income yield. I would expect among the companies that could be most impacted are GE, which could experience up to a $6 billion hit to its equity upon implementation of the new standard. For IFRS, it's the first universal insurance standard in IFRS, so quite significant. For the most common approach for most companies, what this will entail is essentially a best estimate liability for reserves at each period. We'd expect insurers in South Korea and Germany to be the most impacted, just given the significant mismatch in duration between assets and liabilities that they have. However, keep in mind, for IFRS, companies with insurance-like liabilities, such as product warranties, could also get caught up and significantly impacted by the standard. And I'll turn it back to Jen for closing remarks.
Thank you, Richard. Thank you, everyone, for joining us. I am conscious of time here in terms of Q&A, but we are always happy to take any questions. You may send questions to cservices@cfraresearch.com. Also, just before we hang up, wanted to remind people that we're going to be essentially coming to a city near you, and this is our upcoming calendar in terms of travel. So if you have questions about that, or you'd like to schedule a meeting, please contact your account manager, or again, you can use this cservices@cfraresearch.com email for any questions or visits. Thank you for your time.